All right, welcome everybody. Brandon Rogers and Trent Bradshaw with Bradshaw Rogers Financial Partners and Mind Your Money. Wanted to do a review and a video of our State of the Markets event that we're doing. Obviously, we do a lot of these lunch and learns and had a lot of requests for the videos. So again, wanted to put this together for people that couldn't make it and talk about a little bit of 2023 in review and what happened and potentially happened predictions in 2024. So we look at next slide that we have here is just obviously disclosures. Trent and I are both affiliated with United Planners, and again, this presentation is just really for general education purposes, and we'll get kind of right into it. So the contents of today, what we're going to talk about is 2023 and review, kind of what happened, give you that update. 2024, what are some questions to ask? What are things that we're thinking about? Recent developments, things that are going on now and what to really look out for. And then positioning on the portfolios, how we make these decisions that we do, and have a lot of really nice data to look at. So Trent, to get us started for 2023, what happened?
Well, I mean, the first thing that we saw that was a big driver of what the market did last year was really inflation really came down. The Fed did a great job by continuing to battle that. We saw inflation slide roughly about the November time frame. The Fed came out and said that, you know, they may take a little time out to the sidelines a little bit on increasing interest rates at that point and seeing how the past interest rates have cooled off inflation. And what we saw was some pretty significant drive down of that number from the top end to where it is right now. It's still around 3%. And of course, we can discuss that in more detail here in a second. But really good job by the Fed in our opinion, but we got to see how that holds. Are they going to continue to be hawkish, whatever? NASDAQ 100, let's talk about technology. It was the driver.
Yep.
That's what happened. I mean, the technology stocks were the main driver of the market returns last year. Actually, you can boil it down to like 7 of the large mega cap technology companies. And those particular companies did exceptionally well, and you'll see that in the numbers coming here. But the one thing we want to remind you, and we'll talk a little bit about this, 2022 for technology was horrible. So what happened in 23 really got us back close to even, if not slightly positive at this point. Large cap growth stocks, also again, large part of those are technology, outperformed value, the second widest margin since 1978. So again, really focused on the large cap tech companies, the mature growth oriented companies, the chip companies were a big part of that. So artificial intelligence is a huge driver in 23. It looks like it's going to continue into 24. But again, that's kind of what we witnessed during 2023. Financial conditions have eased dramatically. Again, since the end of October, the Fed made it clear that they're going to take a sideline approach to increasing interest rates at this point and watch and see what inflation does. So if we go to this next chart, you'll see a really good illustration of what's occurred. You got the Fed funds policy rate and the median FOMC dot plot projections. May not mean a lot to you, but what it does and what it tells us is this. Number one, the increase that the Fed did on the interest rates as we moved into 2022-23, pretty significant. I mean, it was the largest increase, the fastest increase in a short period of time that we've ever seen. So what the Fed did was very, very aggressive, but they also admitted they were behind the 8 ball in regards to inflation. They thought it was transitory. It was not. It stuck. It accelerated drastically, got over 9%. Now they've got it back down to around 3%. So the interest rate environment, what they increased, did very, very well. And as you'll see on this dot plot, they're seeing out in the future that the federal funds rate could be down around 2.5% to 3%, which is their target. If they get back down there, this could be an environment where bonds perform very well again. They've been awful for the last year and a half, but we just need to continue to focus on that. That may be an opportunity for us. If we go to the next chart, where we're talking about what performed, what didn't, and what you can see, basically it's large cap tech. The top 4 here are going to be nothing but rolled into technology-oriented stocks. You can see the NASDAQ 100, which I think about 60% of that index is represented by about 10 stocks. you'll see that it was up over 50%. But what you got to remember is it was down roughly 40% the year prior. So even though that it was up 55%, again, it's struggling to get back to break even to where we were in November of 2021. So it's been quite a roller coaster ride during that period of time. But all in all, the one thing I'll focus on this past chart, on this chart here, you'll go down the list and you'll get down to where it says SPX equal weight. That's a true barometer of how the overall market did. Because what happens there, they take the 500 stocks that are in the S&P 500 and they give them an equal rating for each allocation within that index. So if there's 500 stocks, every one of them is 0.25%, somewhere in that range, 0.2%. That's the type of ownership that index will own. So it gives us a true barometer of what the market and the overall environment of the economy did during 2023. It was still up 13%, but that was the true growth rate that we saw in the market. It wasn't concentrated in a few technology stocks, it was across the entire board. So that's reality, and that's what we're focused on. The next one, you'll see the individual sectors of the S&P 500, and those top three sectors, technology, communications, discretionary, they're all full of these large cap tech companies. Those were the main performers. Everything else was kind of modest, just like we looked at on the S&P 500 equal weight index. So again, 7 technology stocks pretty much drove the market last year. So Brandon, we're going to roll into the next slide, questions to ask about 2024. We'll talk about inflation. We'll talk about, is the Fed going to over tighten? Is it going to put more risk on the market, potentially push us into recession? How many times have we heard that? Will labor markets hold up? Right now, unemployment looks pretty good. I mean, what is it, 3.7%? So until we get to 4.1, 4.2, I think the Fed continues to hold with interest rates where we're at right now. I think they're complacent. I'm not going to say complacent. What's the term I'm looking for? They're satisfied with where we're at right now, and they're willing to let unemployment climb a little bit in order to make a judgment call on interest rates and what we do going forward. Again, look at overall housing. Housing's remained very, very strong. Look at the geopolitical events. This is the black swan that we can't predict. You know, what happens in Israel? What happens in Gaza? What happens in Ukraine? What happens in China? We don't know. But those are the black swan events that nobody can predict. It's geopolitical. Got to pay attention to it. How will elections affect the market? Oh, that's a big one. Yeah, we got some statistics we'll talk about here. Brandon, take over and talk a little bit about inflation now.
So, yeah, this chart, what we're looking at here is inflation as a whole. Obviously, we all feel that every day. Most people feel it, obviously, when you go in the grocery store, at the gas pumps, and, those are, some of the items that we look at. So this chart really focuses in on those items, right? So you can see it's very interesting to look at overall inflation being around 3.1%, but that doesn't sound like a lot. But again, some of the numbers that we really feel it aren't included in that calculation, right?
And it's usually food and energy, right?
Yeah, food and energy. So when you look at this one, you're looking at juices and drinks up 29%. Uncooked beef steaks from 10%. So these are going to be all your really grocery store items. So you can see how much higher they are from normal inflation.
It's the materials we use every day, the items we use every day.
Roll down to electricity. That's 3.8. That's fine. Motor vehicle insurance, and I've felt that personally go up. Repair household items. I mean, think of your electronics, your refrigerators. I mean, there was a point in time where we couldn't even get them, right? So. Again, a lot of this stuff has really driven inflation, and that's kind of our lifestyle type deals, the things that we need, things that we want to do, sporting events. Look over to the next column, veterinary services. That's not cheap either, of course. You got animals. But again, it's just very interesting to take a look at how this inflation affects these certain sectors.
One of the numbers on here that I thought was interesting was the tax return preparation fees. That's a good indicator of employment inflation. Wage inflation. So even your CPAs and other financial firms have to go up in their cost of what they're charging you because, again, wage inflation's a real big item for small businesses.
Yeah. The next chart we'll look at is just a broader chart going back from 2016 and then obviously having projections all the way out to 2028. Obviously, you got different yellow colored lines. The yellow line does represent that food and energy, kind of that prior chart that we just looked at. obviously it's going to be off the charts. It's got the most volatility, and that is the reason why they take it out of the core CPI index, is because there's just a lot of volatility with that in that number. So that you can just see it all across the board. Then you look at the other colors. You got the purple ones, the durable goods. That's going to be your goods that aren't so much replaceable or reusable, one-time use. This is going to be your household items, your vehicles, your washer dryers, your things of that nature. Housing and other, super core, just different inflation items that we look at across the board. So again, it's peaked obviously in 2020, starting there all the way up into 2022. It's come down. And that's a really good representation of where it is now and where they want it to go here in the near term.
Yeah, and this chart's really good. Like you said, what it's doing, look pre-COVID, pre-2020, it's getting us back into normal range. And that's what's occurring. That's a good thing. And that's what the Fed has done. I think it's working from that standpoint.
Next, what we'll look at is will the Fed over tighten? So this is going to be forecasts from the Federal Reserve on the rate cuts is where we're at. So you can see, obviously, as Trent mentioned on the other slide, that how much it's increased in a short period of time. The biggest, run that we've had in the past 40 years for sure. And then they're really raising rates so they can have more ammo in our arsenal, so to speak, to control inflation and control things out there. So you're seeing the first rate cut potentially coming this year, and then analysts first thought maybe it was in the beginning half of the year, and now the Fed comes out and says not right now. Like you mentioned, they're okay with the way things look. So we got the Federal Reserve projections here going out and where they want to get it back to that 2 to 3 range. And then obviously we got the Bank of England here, so we can kind of look at the other side of the pond, so to speak. And they're in a very similar environment. But again, trending, obviously it went up over there as well, and then trying to get it back down to their normal phase.
And to touch on that chart, when you look at the Federal Reserve and what their expectations are about cutting rates, I mean, the January numbers here, the first month of this year, 24, what we got was a little hotter inflation than expected. So that really, like you said, gave the Fed the information they needed in order to hold rates where they are right now. And that's why we think it's going to be pushed maybe into that June to July timeframe.
Yeah. Next one we got here is will labor markets hold up? Again, you're going to see a spike, and really you see where this chart starts is 2021. Obviously, you look at what happened in 2020 with COVID. The world shut down basically. So there was a reason you have a huge spike at the beginning here, just because we're trying in recovery mode, everybody trying to get back to work. So now you see it just kind of settling back down to normal. And like I said, the Fed basically wants some of the job growth to slow to try to curb inflation. Again, Federal Reserve Chairman Powell basically said you got to go through a little pain so we can get through this. Otherwise, it's just going to stay high inflation for a very long period of time. So again, this is trying to show us that trying to get back to normal range.
I mean, the wage inflation that we're battling right now is definitely something that, like I mentioned, small businesses are battling, but it's also larger corporations. So again, if the demand goes down for those jobs and we get a number of people that are unemployed, then of course wage can be controlled at that point too, or at least slowed down a little from that standpoint.
Next one we got really is been a very big talk about mortgage rates, right? So again, back luckily if you were able to refinance or purchase a home, about a year and a half ago, rates were pretty solid, right? Numbers that we've never seen before, right? But I think that had a problem, or that caused also housing to increase, because again, if your interest rate's lower, you can afford to spend more on a house, right? So again, you can see this chart's very good. It talks about the historical interest rate on the mortgages from 2019. Obviously, then you see it spiking. That's when the Fed started raising rates. And then, trying to get back to normal. Well, I mean, historical normal range is around that 6 to 7%. We've been spoiled for a very long period of time for having low mortgage rates. But again, they're trying to get it back down to that point. Just recently, I think it peaked back up to 7. So again, something to continue to watch. But again, where they're trying to get the rates to that 5, 6 range, I think, and they'll be happy with that.
Well, this chart is a good chart because what we've had multiple questions. Should I buy a home right now? Should I sell my home and move to another location? Well, what this is saying is if you're patient, rates could come down over the next year and a half. And if you want to buy right now, you can, because you've always got the option to refi.
Right.
And I don't think that should keep you from potentially taking a look at a piece of real estate. But ultimately, you're going to have the flexibility to refi down the road and lower your cost as far as interest is concerned. But again, you got to remember, housing's hot. If interest rates come back down, it's going to make housing even hotter.
Yeah.
So we got to watch those home prices and the inflation associated with that. The Fed's all over it. They know that situation is out there.
And again, some people I've heard talk about, well, let's go ahead and let's just buy it now, and then we'll just refinance back to the 2 to 3 rate, in a year or two. Why? I mean, that's a little
not going to happen.
That's a little too wishful thinking, I think. So again, don't buy a home thinking you're going to refi at 3%, run your payments off of that. That's not good.
Well, and historically, it's been between 7 and 8%.
Yeah.
That's the norm. So we're at the norm right now. So if it got back down to 5%, hey, that's a historically low rate. It's something that you could take advantage for a long time.
Yeah. So next one we got is really neat. So this takes a look at the geopolitics. This is going to look at the war times, right? So this chart goes all the way back to 1928 up to now. Obviously, every little bullet point here are some pretty major wars. Obviously, you've got World War II in there, World War I. You've got, Iraq war. I mean, look at, there's a bunch of different Iraq wars on there. So Kosovo, again, all these wars that we've heard about. But regardless, I mean, these things are going to happen. I mean, war's been going on since mankind, right, was created. So, when we look at this chart, it really shows that, yes, there will be negative events, there will be wartime that happens. But again, as long as we have a longer term time frame, it's going to be okay. We got to stay invested. We can't get spooked. We can do things to change in the short term, but don't go to the sidelines and try to wait it out until things get over. Because I know one of the things recently with the Ukraine war, some analysts were thinking, this will only be a month or so, and Russia's just going to go and wipe it out. But Ukraine's stuck in there and continue to fight, and it's been almost 2 years now. So
right.
Again, don't let some negative headlines kind of scare you away. Next one we got here is really neat. This talks about the bull and bear market. So again, bull markets when the market's going up, bear markets when it is down. So the gold portion here is looking at when the market has declined. You can see that happens, and when it happens, it's bad, but also the bull's got to win, right? So you got a raging bull, right? So you look at the different time frames here, the returns since 1942, and it really shows you the ups outweigh the downs, right? They definitely happen. We don't know when they're going to happen, don't know how long they're going to last, but looking at it across the board, things look really strong, and stay invested. The market does win over time.
Yeah, I think the ratio you said was 75-25. So 25% of the time the market goes down, 75% of the time market goes up. Yes, you want to miss the major downturns, but you're not going to miss those. What you want to do is just try to cushion it with your asset allocation, make sure you got some checks and balances in place. And we do that within our portfolios. But ultimately, you just want to be steady with those returns and over the long run win. Brandon, I'll take the next slide. Let's talk about how will elections affect the markets. And what you see on this slide is being fully invested regardless if we have Republican or Democratic representation in the White House. What you'll see here is if you stay invested, pays huge dividends over time. If you get out of the market during a certain administration, then you virtually have very little returns at all. You want to be in the market at all times, regardless if we're talking about Republican or Democrat. Keep that in mind. We're in an election year. This is important. We've looked at the statistics. This is a year you want to be in the market based on what we've read. We can't be 100% sure, but statistics tell us that 83% of the time we're going to have a positive year during an election year cycle.
Yeah. The next one we got here is really interesting. I love all these election slides because they're really great. How will the elections really affect the market? So what this chart's looking at, it's got your presidents listed down below, it's got your Republican, your Democrats, and then it's got how did the market react in each year of their 4-term cycle, right? So again, you kind of see the first one being on average, again, Republican or Democrat, up 9.8%, second up 8.5% roughly, third year up 17.6%, and then the last year up 10%. So pretty strong for the for the full term, and especially the last two.
And it's amazing how it's pretty much on the it's pretty much on that pace right now.
Yeah. So So again, another just representation all the way back from Hoover to now on how the market reacts, and again the averages, they're there, the data's there.
And during that 100-year period of time, roughly, there's been a lot of those uncertainties, like the wars and everything we just discussed.
Yeah.
So I mean, the statistics are there, and especially in the election years, you'll see that it's normally a very positive time to be in the market.
Yeah. And this is the next slide that we got is also kind of breaks things down between Democrat, Republican. Then it talks about can't forget about Congress too, right? So currently, right now, obviously we've got a Democratic president. Congress is split, therefore nothing really gets done, and the market likes that, right? That means there's not a lot of legislative risk out there because there's not enough votes to get actually anything passed, right? So when you're looking at the average returns, this is what we're looking at with the Democratic, Republican president, or the makeup of Congress, right? So it's very interesting to look at. Still pretty solid numbers. I mean, even the worst one being up 7.5%. I mean, I like those averages.
Yeah,
you can't
absolutely. I mean,
that.
if you average 7% every single year from here on out, I mean, there'd be no. It's a home run. So even under the split situation like we have now, like you said, nothing gets done. Well, all in all, it's the best time to be in the market when we have those split House and Senate. Yeah.
Next we use this a lot, and this really has a lot of information that you can see. So again, goes back from 1928 to Hoover to Biden, and it takes a look at the average return of the market overall. So when Republican was elected, the average return's about 15%, Democrat elected about 8.5%. When you look at the election years, and all election years on average up 11.58%. So again, 20 of the 24 years actually provided positive results. That's an 83% chance that was a positive result during those election years. When you take a look at some of the negatives, what were they, right? I mean, some of these things weren't the president's fault, right? I think it just happened to be a certain time in history. That's proven with the 2008 financial crisis that you have there. That's a big negative year, obviously we all remember. You go back to the tech bubble in the 2000s, that was a negative. World War II, it was a negative, but then wars actually, the market usually does good after the fact, right? Because we're ramping up production. And then you go down and you see the Depression, obviously at the very bottom during Roosevelt. Obviously that was a bad time. So not terrible numbers there either. So again, idea here, stay invested. Don't let your political views get in the way of investing. Let's stick to the approach. Let's manage risk and make changes as we see fit.
But before you jump off this slide, let me add a couple other statistics to this. You mentioned 83% of the time during an election year, we normally see positive results, and the average being 11.6%. But think about what's happening right now. We talked about the Federal Reserve, we talked about inflation and what the Fed is viewing. The dot plots right now say we'll have anywhere from 0.75 to 1% in interest rate cuts before the end of the year. That's additional liquidity that's going to flow into the market. That money is that's billions and billions of dollars that will flow into the market if that actually occurs. Normally, that's what happens. The last part of that is how much money is sitting in money markets right now, because money market mutual funds right now are anywhere from 4 to maybe 5.25%. It's trillions.
Millions, billions,
trillions. It's trillions of dollars. So when you talk about a tailwind in regards to the market and what could happen during 2024, if rates start to be in a situation where the Fed cuts those heading into 25, people are still going to want that 4 or 5% yield on their money. Well, they're most likely going to take that money market money and push it back into the market, dividend-paying stocks. Yeah. Value has been out of favor. Dividend-paying stocks did horrible last year.
But that's because you could get that risk-free money pretty much. And get the dividend yield, right?
And it's a good point. We tell clients all the time, if you can get 5% in the money market right now with zero risk, why own a stock and try to get 4 or 5? Own the money market and get paid 5. It's a brilliant approach, because you take the risk off the table. But if that environment changes, we have trillions of dollars as a tailwind that could potentially push the market as we move forward too.
Yeah.
All right.
Definitely positive. Now look at this next one that we have here. It's just basically the first year of a presidential return. So again, we've been talking about the election year a lot right now, and then what happens first of next year. How does the typical first year of a presidency work. So again, you can look here. Again, breaks it down Democrat, Republican. Doesn't look at really Congress at this one. Just looks at who's at the helm, right? So again, going back from 77 up until 2021, the first year, you can see the chart. Chart kind of speaks for itself. We're Democrat, the average in the first year is up 20%. Republican up 12. Again, both positive numbers. Democrats are up higher typically, and the reason we get that question a lot is usually Democrats like to spend more money and stimulate a little more, and that's typically good for the market, and that's why you're seeing historically why usually the market does better when the Democrats at the helm.
Well, again, another good example, because look back at 1977, 1981, where were we at? Inflation was off the charts.
Yeah.
You had mortgage rates that were double digit at that point. Paul Volcker came in and had to be really aggressive on interest rates to get them back down. And then we saw the growth of the 80s and 90s. Probably the biggest bull market we've ever witnessed. Mm-hmm. But then you even come into 2001. Well, when we came into 2001 and the market was down, what was happening at that time?
Technology was taking on the chin.
Bubble. Anything.com went up 100% on IPO day. Which is ridiculous, but that's what was occurring at those points. The other years, look at them. How impressive is that? That's why we feel positive about 24, because statistically and what's happened in the past tends to repeat itself.
Yeah. So next, what we're going to look at is kind of developments. Keep an eye on what are we paying attention to. Obviously, the data will drive a lot of our decisions. But again, hawkish central banks, recession fears, eclipsed inflation fears. Will we end up in a mild recession? Again, you look back to 2023, a lot of analysts thought it was going to be a horrible year because we're going to have a big recession, and it didn't happen, right? Market did really well. So again, if you listen to all that, you potentially missed out on it. Again, or no recession, right? I mean, did it really happen in the past in 2022, but nobody really wanted to call it, or they changed the definition? Again, there's a lot of reasoning behind that, but still we won't go there. But again, is a recession going to happen or not? So I think now basically analysts are saying it's going to be very mild or none at all. So again, we'll look at that. China slow down. Obviously, China's always going to be a big deal, so we got to pay attention there. Sluggish GDP growth. Again, got to getting back into those normal ranges.
That's possible. The global slowdown as far as GDP, that could happen because of the inflation environment we're in. The Federal Reserve, just like other central banks, they're working very hard to get inflation under control. So that will slow growth if they get too aggressive.
Yeah.
Yeah.
Rocky geopolitics, that's what we just talked about. Again, we had a lot of charts about the wars, things of that nature. Again, we mentioned it before, Ukraine, China, everything that's going on over there, right? Then we just got to, again, have a defensive posture when needed, right? And that's something we take a close eye on, and that's what we do. We'd more so take a defensive approach if things get kind of out of hand or kind of rocky.
It's risk management.
Versus getting out, right? And again, that's what that last bullet point here. We've got to think long term if that's your investment horizon, which a lot of people it is, because even if you're in retirement, yes, your risk management is one of the most important things, but hopefully your retirement lasts 10, 20, 30 plus years, right? And that's a long time, and you need to have market exposure there, but let's protect as best we can on the downside. So again, don't try to time the market. Don't let politics get in the way of your decisions, and basically stay the course. And that's when we lead us to this next chart that's really, really neat as well. Going back from the 80s all the way back to 2023, this talks about the intra-year declines, right? So again, everybody focuses on, well, what did the market do during the whole year? Well, yeah, that's easy to look at, but you also got to look at the ups and downs that you have throughout the year, because the market goes up, market goes down, right? It can be some kind of seesaw type effect throughout the year. So what this is showing is, on average, there's about a 14% intra-year decline on average. 14%. That blew my mind. That's massive.
That's significant.
And that during that ride, I mean, it's very emotional, right? So again, if the market goes down, people, they want to pull out and go to cash, but that's like the worst thing you can do, right? So don't try to time the market. Stay the course. Do the risk management on that end, and it will work over time.
Next slide is going to be our approach to how we manage our portfolios when it comes to our stock exposure. What you'll see here is, core positions. We're always going to have that core position because it's a situation where, like Brandon said, don't try to time the market, be in the market. So we're always going to have some exposure to the market, but we do have our core defensive and also defensive areas that can represent up to 25% of our equity portfolios. Right now, we're more positive like we talked about. So that 15% is in equities at this point. The other 25% on the other side that says aggressive, again, we're heavily invested in large cap growth and technology. It hasn't changed from 2023 to where we are now. If the Fed cuts interest rates or they reduce quantitative tightening, which they're letting money roll off the balance sheet, which is exactly what they're trying to accomplish, we're listening. That'll bring back in potentially small and mid cap stocks back into the portfolio. But right now, large cap growth, technology, the environment hasn't changed at this point in the first quarter.
Yeah, so typically we will make these changes at a minimum on a quarterly basis, but if things go awry and we get data that tells us to make a change, we will. And we just do it, like say, across the board because there's a reason we're doing it from that end. So again, very good approach. It keeps us focused. It kind of keeps the emotion out of there, right? Because we just saw a bunch of charts that's full of emotion. So, but like you say, over time it's been proven that it does work. It will be choppy. Could be choppy for a day, a week, a month, a year, a couple years. Who knows? But overall, like I said, it's all about time horizon and how much risk that you're willing to take out there. So. But again, that kind of wraps it up for the State of the Market update for 2024. Be sure to follow us on social media. Our YouTube channel will have all these videos out there. Come to our lunch and learns if you can make it. We'd love to have you. The podcasts that we'll have out there are very good options to look at and very good educational topics that anybody can listen to, from a child all the way up to a grown adult. So some very good information that we always want to make sure that's out there. Got any questions whatsoever, just let us know. But again, thanks for joining us. It's Brandon Rogers and Trent Bradshaw with Mind Your Money and Bradshaw Rogers Financial Partners. See you next time. Ooh. Bam. Laptop works, camera works, mic works.
Just defer it to me.
Okay. Win.
I think it went well. I think we did a good job on that. What you done?
Yeah.